The market has been pretty insane the past couple of months. The Federal Reserve just announced that they're not cutting rates, and their outlook is a little bit dim currently. Also, tariffs are still on the horizon. We still haven't seen really the data to back up whether or not this is going to pull us into a recession. But you know what? What have we been doing? We've been investing $10 a day every single day, and we've been doing pretty well. So today, I'm going to show you what the portfolio is looking like, just give you an update on what stocks are still in there, some of the stocks that we've sold, and, just give you a quick update. We have been investing for about 590 days, which is a little bit over 19 months. So if you're new here, hi, I'm Pasha, and I'm a financial advisor, MBA student, and I make these YouTube videos for fun, just tracking the progress of this challenge portfolio that I've been working on for the past, like I said, 590 days. Anyways, let's jump into this portfolio. Let's see what we have to uncover. First and foremost, we have gone pretty heavy on long-term treasuries. So we're sitting at about 30% in long-term treasuries. I feel that these are pretty good value right now, especially, I'm expecting the Federal Reserve to cut interest rates at some point in the future. And long-term bonds fluctuate the most whenever interest rates fluctuate. So I think that it's fairly small chance that interest rates will be higher unless something really crazy happens. I think that it's most likely that they'll come down. So I think this play is fairly safe for, collecting a yield on my money while also being able to play on that lowering of interest with, treasuries basically going up if interest rates come down. So there's that. We got Target. It's our largest player. Just wanted to say also, I have been kind of, rotating more into dividend-paying stocks. Dividend-paying stocks, kind of value stocks, fundamentally sound. I'm staying away from some growth stocks. We did have some earnings pretty recently on Block, which we did have, just under 5% weight in the portfolio. And those earnings were terrible. If you can see here, it was like a, 20% drop. So we did buy a little bit of Block, but anyways, that's more of a growth play. We have like PayPal, a couple other things in here that are more growth stocks. But I'm trying to rotate into more dividend and value type of companies because if you're not new here, I have mentioned that the S&P 500, I believe, is fairly overvalued based on historic valuations. And the next, 3-5 years could be very, very poor returns on, the S&P, on things like the NASDAQ. I think we're kind of in a bubble currently. So, value stocks usually outperform during times like these. Anyways, we got Comcast, that's a dividend payer. Atcor is a dividend payer. CVS, Elevance is a little bit of a low dividend payer, but it is healthcare just like CVS. So I think this one has potential to grow their dividend. PayPal's growth, as you can see here, our total returns are not doing too bad on these positions. Our big ones are really our Chinese stocks, like Alibaba at 44%. T. Rowe's a crazy good dividend payer. This one is going to fluctuate with the market. So if the market goes down, this one's going to go down. This is a 401k retirement company, investment company. So looking at the dividend, I was actually buying up when the dividend was around 6% during, about a week ago or a couple weeks ago. It really came down quite a bit, or actually it was about a month ago. So it went all the way to $80 a share, and it was yielding 6%. So, it's investments like these that it's like, I feel like they're not going to be able to go down much more. And during that really big market downswing, a month ago, it's like some of these value plays, they're just too good to pass up. But we got Baidu and JD. Those are our Chinese plays. Not as crazy returns as Alibaba, but still doing okay. Google, I'm thinking, is getting close to a price that I want to start building the position a little bit more. Out of the Mag 7 stocks, I think Google is probably the most fairly valued. This company is really going to have constant growth, I think, moving forward. I think they're very innovative. They did start paying a little tiny dividend, which they'll probably grow over time. But price to earnings ratio of 18, I mean, that's not too bad for double-digit annual growth moving forward. They did have some bad news, but like honestly, Google is one of those that I think the more bad news that we get, the better I like it, because I'm going to be buying up as the market's selling off. So that's Google. We do want to build that up. Stellantis, definitely a lot of bad news around this one. Automakers, they're getting massive tariffs. There are talks about a lot of these automakers getting, some kind of waivers or something like that. But while there is bad news on it, this is a pretty stable company as automakers go. The stock definitely is not stable. If we look at the max, we're sitting like almost at all-time lows. This was a offshoot, I forgot of which company, but since 2014, whenever this went live, Stellantis, like we're looking pretty good. We're looking like we're hitting a fairly long-term trend line. So I'm not too mad about being in Stellantis. May possibly bite off on a little bit more, but there's that. Here are a couple that we bought up right at the bottoms, Disney and Nike. Disney is an interesting one. I think it's a pretty good value play. Their price to earnings ratio is a little bit inflated, but they are getting better margins with their streaming business and everything. I know this isn't too large of a position. It's less than 2%. But I did buy it on that really massive dip. Same with Nike. I think these are two that just got slaughtered in the market. But I'm honestly a bit tempted to sell off a couple other winners up here, and just start buying up, really quality dividend value stocks, and just kind of go that route for a little bit while holding treasuries and see where we, come off with that. But on our yearly, we'll probably pop it up over here, but the weighted annual return is 24% or so. Doing very well. We are getting alpha against the S&P 500, against the NASDAQ, against a lot of other indices and ETFs and whatnot. So here we can see 16%, but I'm basically depositing $70 a week. So you kind of have to, it's not like I put in $10,000 and I'm trading with it and seeing actual returns. This is just showing my total return based on what's in here. So the weighted annual return is really showing the portfolio performance, which is closer to about 24% over the past 2 years since we started this. So looking pretty good. And if we compare that to the S&P, let's just come down here. The S&P is 1 year performance is 8%. NASDAQ is just a little higher at 9.6. So the portfolio, I think, is doing very well. I think, one of the reasons is because we have these long-term treasuries kind of as a hedge. They are preventing us from, they're a little bit of our plunge protection team over here with the 30% weight. We did pick up a little more, but, the portfolio is doing fairly well. Now, I think we need to go over here and see what some of our sells are. So 1 second. All right, so we're going to our realized profits and losses. So we're not going to go to max. Let's just go to our past, we'll say 3 months, because I'm posting this video a little bit late. We did sell off all of our Intel. We sold off all of our Ulta, both at, small profits. But here are really all of our, we did sell off Dollar General as well. That one shot up quite a bit. So anyways, those are our realized profits and losses. So just under $300 realized. Come around tax time, we'll have to pay taxes on those. Let's actually check out some dividends as well for you dividend hogs out there. Okay, dividends. So long-term treasuries paying out fat dividends. Stellantis got us a really nice one, honestly, for the amount of money we have in it. We did reinvest that. But those are our most recent ones in May, but here's April. So April we got, about $16 in dividends. March. So, overall we're growing the dividends little by little, and in May we already have over $20 of dividends. And like for a portfolio like this is super tiny. So, you know, growing the dividends is going to be very fun. And at some point we'll probably track them, but this is just the $10 a day to till I hit 10K challenge. So the dividends are not going to be crazy, but you know, it's still fun to check it out and see how it's going on the dividend front. Anyways, if you guys enjoyed the update, make sure you drop a like on the video. It really helps push this video out to new viewers. I really appreciate it. Also, commenting does help me in the algorithm. So for today's comment, drop a comment and let me know what stock you're looking at right now, because you know, over the next several months we are going to potentially see a market pullback, maybe even more significant than what we've already seen. And you know, you got to have that trigger hand ready, because you know, bargains don't come up for too short of a time. So anyways, drop that comment, let me know what stock you're looking at, and maybe it'll actually give me some insight on what I need to buy in the $10 challenge. Also, if you're not subscribed, make sure you subscribe. I appreciate you guys, and I'll see you in the next one.